So good afternoon, everyone. Thank you for joining us today. My name is Balram. So, I am managing partner of Spectrum Auditing, Spectrum Accounting, and founding partner of SBC Tax Consulting. We have been into this for last 10 years, and we provide VAT, corporate taxes, transfer pricing, accounting, audit, and company formation services. And along with me, I have Rashid, who is going to be part of the presentation team as well. So he is a CMA qualified professional, and he takes care of the value added tax team. So I'll start the session, and then after a while, Rashid will take it over. So today we are going to talk about the common mistakes that are generally taking place in VAT filings, registrations, deregistrations, and how can we correct them, if at all, if there's any possibility, or how can we avoid them. Being aware of the common mistakes itself will help us in avoiding those mistakes. So that's the whole objective of conducting this webinar today. So as part of this, we have received some of the questions from some of you. We will try to address them at the end of the session. If we are unable to answer them, we'll try to get back to you directly to you. So as part of this, we will try to cover these topics, which we identified as areas where we have the opportunity or possibility of having more mistakes. Okay, so then we try to talk about what is the right way to handle it and what are the mistakes that are generally happening, so that we can avoid getting into those issues. So the items are like, the expenses which are allowed and not allowed to be deducted. Expenses which are allowed partly are allowed subject to taking care of some certain compliances. Then you can take them or claim them as input tax credits or recoverable expenses. And what are the issues with respect to registration and deregistrations? What requirements do we have? When do we have to go for deregistration on voluntary basis and on mandatory basis? If you are expected to go for deregistration on mandatory basis, if you do not do it in time, you will get into penalties. What kind of mistakes can we identify and report under voluntary disclosure? And what does not require or do not require voluntary disclosure, and you can correct them without going for voluntary disclosure. That also we will discuss. What are the requirements of tax invoices? What is called as right tax invoices? And what requirements do we have to comply with when we do import and export of goods? And what are the requirement or expectation from the point of view of keeping the records, books of accounts maintained from VAT point of view? What exchange rate do we have to use, and what kind of issues we may get into with respect to exchange rates, and advance payments that we receive from the customers, and what is the requirement from VAT, and when we make payments to suppliers with respect to our expenses where we have taken input tax credit, what is the time limit that we have? If we are not making the payment within that time limit, what will happen? At the same time, taking the input tax credit or claiming the expenses, what is the time limit that we have, and other tax records that we have to have. So these are the topics that we will try to address and attend to. What kind of requirements are there, and what kind of issues we may get into, and how can we address those. So these are the areas that we want to cover or focus on. We know what is the issue if we are not able to comply with the requirements of VAT. And we may get into penalties. The penalties are ranging from 1,000 dirhams to 10,000 dirhams on an administrative basis, kind of penalties. Penalties with respect to tax are different percentages we have, and then maximum amount of penalty could be up to 300% of your tax amount. So these are the penalties that you may have. So it is better to avoid those penalties and make sure that you're complying with the requirements of the law in time, in a right manner. So you may also, if you do not follow the VAT law, you may also get into a position or a risk of audits from FTA. FTA may ask you to provide additional information, or FTA may say that we would like to visit your office and business, conduct audit. So if there's any suspicious transaction or arrangement, the possibility of picking up for audit is higher. So that is one risk that we may have. At the same time, if your company is picked up for audit or not able to comply with VAT requirements, and then audit is being done by FTA, and you found guilty or non-compliance of the law, so the reputation of the company and businesses will definitely be at risk. And that time, if you try to correct your documentation by reaching out to your client and suppliers, there you may have to explain why you're reaching out to them afterwards, and then they will definitely come to know about the issue. That will definitely keep or have issues with their reputation. So instead of that, comply with all the VAT laws and requirements, and no risk from financial side as well as business reputation side. That's the whole idea as to why we have to comply with the law and what the risk that we get into it. So most common areas of having uh, non-compliance or errors with respect to VAT are like documentation errors. The errors could be with respect to your invoicing, tax invoices. You may raise invoice which is not complete, or you may receive invoice from your suppliers which may not be complete. So it is important to look at the requirements of the tax invoice, and when are you expected to raise tax invoice, the time limit, and when are you expected to have tax invoice for your expenses to be able to claim input tax credit. What are the rules around this? You also need to look at what are the minimum information or requirement of information that you have to maintain on your tax invoices. So this will be helpful for you to understand what is the right invoice when you raise invoice on your customers, what is the right invoice when you receive from your customers, and when within what period of time that you have to get the invoice or issue the invoice. And with respect to imports and exports, especially with respect to exports where you are able to classify them as zero rated supplies. So to classify that as export of services or goods, you need to have right information and right documentation in place. So we will go through what is the documentation that we require with respect to imports and exports. But if you do not have those documents in place, or documents with the right information in place, then you may not be able to claim that export as zero rated supply. Not only export, but any other zero rated supply that you are claiming to or going to claim for, the enough documentation is required to be there in place. If you don't have that, you cannot claim that as import or export, in which case you may have a risk of classifying them as standard rated supply and pay VAT of 5% on that. In which case you may or may not be able to cover that or collect that amount of 5% from your customers, but you may still have to be or expected to pay 5% VAT out of your own amount. And not having the proper records of bookkeeping in your business. Sometimes the FTA may ask you to submit bank statement or the trial balance and financial statements, and they may give you only limited amount of time to get back to them. So in which case, if you do not have documents in place and FTA does not allow you to extend the time, then definitely you are in trouble. So these are the areas where you may have to have proper documentation in place and avoid having or getting into errors with respect to documentation. The next category is calculation errors. Errors could be of applying wrong rate. It could be because of wrong classification. The supplies that may have to be classified as standard rated supply with a 5% VAT. If you classify them as zero rated supplies or out of scope supplies, then it is a wrong classification whereby it will be a wrong calculation or wrong VAT rates applicability. At the same time, if you have transactions in foreign currencies or international transactions, and you're expected to apply the exchange rate as on the date of the supply, and that rate should be based on the rates that are given by Central Bank of UAE. And if you do not consider that rate and if you take a different rate, the transaction value is going to be wrong, and the transaction that you report in VAT returns will also be wrong. Whenever you identify or FT identifies them, it becomes a non-compliance and will be subject to penalties depending upon when is it identified. And incorrect treatment of advance payments, either advance received from your customers or your payments to the your suppliers. When you receive advances, you are expected to raise your tax invoice within 14 days from the date of supply. If you received advance but you have not raised tax invoice and you have not complied with the return filing dates, that is an error, and you will be subject to penalties if it is identified later, either by you or by FTA. And most commonly, areas of errors or mistakes are input tax related areas. You are having expenses, but whereas you may not be eligible to claim that as input tax or recoverable expense or input tax credit on that, but you still claim that. We'll go through those areas, but that could be one of the area. And you are expected to claim your input tax credit on your expenses within a certain period of time. If you're claiming that beyond that period, that is also a wrong claim. You are expected to make the payment to your suppliers within certain period, which is 6 months from your due date. If you are not paid within that 6 months period, whatever input tax credit that you claimed on that transaction, you are supposed to reverse that and only take it whenever you make the payment. So these are the areas we have to have enough controls in place to be able to track those transactions and make sure that you make the payment or you made the payment within 6 months. If you're not paid within 6 months, then you have to have enough controls in place to make sure that that amount is reversed in your VAT returns when you file next, and it is only claimed whenever you make the payment. So these are the general areas where you may get into issues with respect to non-compliance, or you may have errors with non-compliance in terms of classification or documentation with respect to your transactions. So there are certain expenses, as I mentioned. So the tax which you pay on them, either you may have limitation on taking the amount, or you may not be able to take, or you may have to claim only part amount, or you are eligible to claim that amount as input tax or recoverable expenses only after meeting certain conditions. So one of the most common area is the entertainment expenses, the food and drinks, accommodation, and certain kind of access to shows or events, pleasure trips. So these are the expenses on which whatever VAT you pay, you may not be able to claim input tax on them. And especially whatever expenses you pay towards the customers, suppliers, and owners of the company, expenses that fall under this category, you're not supposed to claim any input tax credit on them. So that's one of the main area that you have to look at. So when you make the accounting entries for these transactions, you have to make sure that this category of transactions are accounted separately. And when you file the returns, this category of transactions are excluded from taking input tax credit. While accounting itself, you are supposed to show this with not showing or not classifying the VAT amount into input tax or recoverable tax amount, whereby this amount will not fall under input tax credit when you summarize your transactions. And next category is motor vehicle expenses, that we will look into it more details. And you also have mobile expenses, mobile phones, the SIM cards that you give from company, or you may reimburse your employees related mobile bills. Then what is it that you have to look at? Can you claim it or not is what we'll look at. And employee benefits, some of the benefits that you are providing or offering to your employees without charging them or without recovering any amount from them. So these are the areas where generally you have limitation on taking or claiming input as credit. Now let's get into each one of it and then discuss in detail. As I mentioned, any entertainment expenses that you incur which are falling in this category generally are not available for your input as credit. the expenses that are incurred for your suppliers, customers, and owners. So there is a restriction on that. But if you incur this category of expenses which are related to business for employees, then that category or that expenses related VAT you may recover. But if it is incurred for suppliers, customers, and owners, so that amount you will not be able to claim input tax credit on that. So you can see that the expenses like restaurant bills, like if third parties, if it is not only for employees but also for families and your other customers and suppliers, then in that case you may have to look at it whether it is allowed or not. But generally it is not allowed. Client dinners, as I mentioned, hotel accommodation for non-employees, entertainment events, like you are paying subscription fees for any club for your owner, that may not be eligible to claim as input tax credit. Gift given for personal enjoyment, maybe gifts given to your suppliers and customers. So that is something that is not allowed to take input tax rate on those expenses. But yeah, just on the other hand, the light refreshments that are provided are offered in the office premises for the employees, and the accommodation that is provided to the employees, which are legal requirements or contractual obligation, and that is allowed as or offered in the industry as general practice, and that provision is required for the employees to be able to conduct their duties. So in that case, whatever tax that is paid on that, VAT paid on those expenses can be claimed as input tax credit. So vehicle expenses which are incurred, be it the amount that you pay to purchase the vehicles or the amount that you pay as rent to take the vehicles on a hire basis, or expenses you pay as maintenance or fuel bills. So all these expenses, whatever VAT you pay on that, you have a limitation on taking input tax credit. So if those vehicles are 100% used only for business purpose, and you have documentation in place to demonstrate that that vehicle is only used for business purpose 100%, and that is not at all available for personal use of the owners or employees or any other. So in only that case, you can claim input tax credit on the expenses that you incur for the vehicles. If the vehicle is used partly for personal purposes or fully for personal purposes, you're not at all eligible to claim input tax credit on these expenses. In the case where you have vehicles available for partly personal purpose and partly for business purpose, so in that case, you may have an opportunity to still claim, but you still have to have a proper policy in place to demonstrate what is the portion that is used for business purpose and what is the portion that is used for personal purpose is what you have to demonstrate. The general practice in those areas are like you have to have a policy in place as to what you call as business related use and what you call as personal related use. And you also need to maintain the logbook for your vehicles. When is that vehicle used for business purpose and when is it used for personal purposes? What is the mileage from which kilometer to which kilometer you use it for business, and what is the purpose, who has used? So all that logbook needs to be maintained. And if you're claiming that that vehicle is used only for business purpose, they also, in addition to all this documentation, they also ask you whether you are leaving the vehicle in the office premises during the evening and night and weekends to demonstrate that it is purely used only for business purpose. So the ideal way to do is, if the vehicle is used partly for business purpose or partly for personal purpose or fully for personal purpose, the advice is not to claim any input tax credit on any of the expenses incurred for these vehicles. But if you want to claim for partly business and partly personal purpose usage situations, then you have to have a proper policy in place. Documentation should be there to demonstrate that it is used for whatever percentage or ratio, and then you claim only that percentage of expenses and VAT which is related to business. So this is what we advise generally. You also need to look at the balance between your cost or the risk versus the benefit that you're getting. So if it is the benefit is lesser or minimal, but the risk is higher, definitely is advisable to not to claim any input tax credit on the expenses related to vehicles. On the other hand, there are areas where some of the businesses are allowed to claim input tax credit on the expenses related expenses, vehicles related expenses. These are like businesses which are into taxis and public transportation, vehicles which are used for emergency purposes like ambulance and police cars, driving instruction vehicles, vehicles which are used by driving institutions for driving purpose, rental cars provided for resale or lease by the businesses. So vehicles which are used in these businesses, expenses incurred on them can be recovered. Similarly, expenses paid on mobile bills, fuel bills we covered a large extent in the previous slide itself. There are cases where you may give a SIM card or SIM to your employees. The SIM may be registered in the name of company, or you may have a policy where employees are allowed to use their personal SIMs and they are used for business purposes. As we know, the mobile bills primarily, there is a possibility that they can be used for business calls as well as for personal calls. We advise our clients if the benefit is not much or significant, since we have a risk or high probability of raising a question on these bills when you claim input tax credit on by FTA, we advise them not to claim. But if you have significant amount of expenditure that you incur as because of the nature of your business on mobile bills, then we advise you to have a proper policy in place. There should be HR policy which should mention that what is the method on which you are identifying your business calls and identifying your personal calls, and how are you going to claim or separate or and compute the expenses related to only business, and only that percentage amount related VAT also is claimed. So what kind of documentation you have in place? For example, I have seen policy like whatever personal calls that you make, so the employee or the HR will be circulating the bills to the employees at the end of the month. And in that bills, employees are expected to identify the calls that are made for personal purpose. And HR will deduct that amount from employees from their salaries or collect the amount from them directly. And only that percentage of the bill which is used for business purpose out of this process and VAT paid on that particular amount will be claimed as input tax credit. So if you have this kind of policy in place and process in places to identify and accordingly claim only that amount of VAT, that is when you have less risk. But otherwise, it is advisable to claim only or not to claim VAT on your mobile bills. To some extent, landline bills are also prone to this risk. But since the landlines are in the office and then generally you are expected to use for business purposes. But there also, if you have or possibility of using it for personal calls and all, if there's a separate bill for those calls, then you're expected to identify them and then not to claim input tax rate on those on that portion of the amount. So from here on, I would invite Rashid to take it over, and then we will address your questions at the end. Rashid, over to you.
So thank you for sharing the valuable insights. So from here onwards, I'll be taking it over. So here there are some mistakes that generally happens during the VAT registration process or deregistration. So as you all know, there are two types of registrations. One is mandatory registration, one is voluntary registration. So there are thresholds safety has given for registering for VAT. So for voluntary, if you would like to register for a VAT on voluntary basis, so you should have made a taxable supplies or incurred taxable expenses of at least 187,500 dirhams during the previous 12 months period, or you are expected to make taxable supplies of this limit during the next 30 days. So 187,500 is the limit for registering for VAT on voluntary basis. On the other hand, if your taxable supplies cross a limit of 375,000 then you are expected to apply for VAT registration within 30 days on a mandatory basis. So if you fail to register on time, then there will be a penalty of 10,000 dirhams for late registration. So here the questions comes, what is a taxable supply? So taxable supply includes standardized local supplies, then zero charge supplies when you are exporting goods or providing services to a customers outside UAE. Then importers goods and services. These all are counts when you calculate the registration threshold. So here, like registration, there are cases when you have to deregister your TRN. Okay, so there are some cases when your business is required to register deregister from VAT. So I will be explaining those scenarios. So one is cessation of taxable supplies. When you stop making taxable supplies, then you are required to deregister from VAT within 20 working days of the event happens. Okay, then the other one is if your taxable supplies or imports or expenses of previous 12 months are less than the limit of 187,500, then you have to mandatorily deregister from where within 20 working days from the date when your turnover falls below this limit. And of course, if there are any changes to your legal type on the license, suppose if there is a change from sole establishment to LLC, or LLC is a sole establishment or civil company. So if these things happens, then you are required to deregister the current TRN number and need to apply for new registration if you are meeting the threshold for registration. So here, some points we need to be keep in mind is you have to apply for deregistration when you are required to do within 20 working days of the any of the above events happens. If you fail to apply for deregistration, there could be a penalty of 1,000 dirhams per month and it can increase up to 10,000 dirhams. And some people may think after doing the deregistration, so they are not required to re-register again when they meet the registration threshold. So this is one reason that many people are getting the registration penalties. So after deregistration, so whenever you meet the registration threshold, that means when you make taxable supplies of 187,500 minimum in the future, then you can register for VAT voluntarily. Oh, next one is yeah, filing the voluntary disclosure. When and why to file the VD. So voluntary disclosure is a mechanism given by the FTA to rectify the mistakes, errors or omissions in the VAT return which you have filed previously. So there are certain scenarios where you must have to file the VD or you can choose to file VD. So voluntary disclosure allows businesses to correct the errors in the previously submitted tax returns or refund applications. This promotes compliance and minimizes the penalties. So here one scenario is suppose if you have underpaid the tax or overclaimed the input in the previously filed VAT returns and the tax difference is more than 10,000 dirhams. Suppose if you have claimed a VAT amount of 10,000 but the actual amount sorry, suppose if you have paid a VAT amount of 10,000 but actually you should have paid 20,000 or more but you paid only 10,000, you reported less local supplies in the previously filed VAT return, then you are required to apply for voluntary disclosure and correct the return. This is a mandatory requirement when there is a tax difference of more than 10,000 for the local transactions, local supplies. And there are also some scenarios, even if there is no due tax impact, you are still mandatory to file the VD. So those things will be covering in the coming slides. Then next one, another case is overpayment of tax or underclaim of input. Suppose if you have paid tax which is more than it should have been, or if you have claimed input which is less than it should have been, then you may file the VD. So it is not mandatory to file the VD, but you can choose to file the VD because here FTA is getting additional revenue and you are losing the revenue. So if you would like to claim those inputs, then you can choose to file the VD. And the other one is incorrect reporting or categorization. So as I said before, there are some scenarios where you have to mandatorily file the VD even if there is no tax difference. So one case is if you are reporting sales, so in the VAT return you will be reporting sales Emirates by Emirates. So many people thinks that if they supply goods to different Emirates where the customers are located, so they might be thinking that the location of the customer is when we need to report. The location of the customer, it will be considered for the Emirates wise reporting. So this is a misconception. So here, when we file the VAT return, we need to consider where do we have any fixed establishment in any other Emirates or not. So I can give you one example. Suppose if you have a registered business office in Dubai and you have a branch or warehouse in any other Emirates, let's say in Abu Dhabi, let's say. So if you process the order from Dubai office, if you send invoice from the Dubai office, but the supply, the goods, delivery of the goods happened from the Abu Dhabi branch or Abu Dhabi warehouse, then that particular transaction must be reported under the Abu Dhabi Emirate. It is not the sales of the Dubai Emirate. Like this, we need to report. So it is always uh, so it is always required to report where do you if you have fixed place of establishment in any other Emirates. So location of the supply is where we need to consider when you file the VAT returns. This is the important area and where people make mistakes more. So as Balam sir mentioned before, so you need to issue proper tax invoice when you make taxable supplies, and likewise when you claim the inputs, you need to make sure that the invoices which you are receiving from your suppliers are proper tax invoice. So there are two types of tax invoice. One is simplified tax invoice. The other one is a full tax invoice. So on full tax invoices, what are the items we need to be displayed? So will be explained below. So here the word tax invoice must be clearly displayed when you when you issue tax invoice, when you issue invoice. So some people will be issuing invoices, but they do not mention the word clearly tax invoice. So if you are receiving invoice from your supplier and the tax invoice word is not displayed, then you are not allowed to claim input VAT. Likewise, when you send invoice to your customers, you have to issue a proper tax invoice. That word should be clearly displayed on the invoice. Then supplier's name, address and TRN. This is mandatory to display on the invoices. And if the recipient, if your customer is a VAT registered person, then you have to mention the name, address, TRN of the customer. Then you have to follow a sequential invoice number and display on the invoices. Then date of issuance. So date of supply needs to be mentioned. Generally, the date of supply will be a date of invoice in most of the cases. In any other case, if date of supply comes before the invoice date, then that date must be mentioned over the invoice. Then you have to give the description of goods or services that you are providing, then unit price, quantity or volume, then VAT rate related to the each line items and VAT amount. These items should be displayed on the invoices. Then if you have given any discounts, then that discounts also should be must be clearly displayed on the invoice, and you have to calculate VAT after the discount, the value after the discount. Then gross amount and VAT amount payable should be displayed, and it should be expressed in the dirhams. Then if you issued invoices which is in another currency other than AED, so you have to disclose the exchange rate based on the date of supply by using the exchange rate published by the Central Bank of UAE. And you have to convert that amount, and you need to show the AED amount in the invoices together with the exchange rate applied. So here some possible mistakes happens. Some people like suppose if the currency is in US dollar, so some of the businesses are using the exchange rate like 3.673. This is not right. So the correct exchange rate is 3.6725. So you have to mention that you have to take the decimal points completely, what is published by the UAE Central Bank. Then if the recipient accounts for VAT include statement of reference reverse charge, if reverse charge mechanism applies, then that particulars, and you need to include a statement referencing to the RCM which you are applying on the invoice. Here, most of the people will be having a doubt what is address. So we have seen some scenarios where people are using only PO box instead of full complete address. So as of now, FTA did not mention what is address. FTA did not give any reference what is address. So it is okay to display PO box, but in order to make sure that full compliance, we recommend you to mention the full address, including your office number, building name, city, and emirate. So we recommend you to make sure that this full address must be displayed on the invoice instead of just showing the PO box number. So here next important area is import of goods into UAE, and what are the actions needs to be taken care. So as you all know that import of goods will attract RCM, where recipient importer has to account for VAT. So in general, like we have seen some cases where some people are reporting the output tax but forget to claim under RCM, or not at all reporting the import of goods. Now, generally import of goods will come in the VAT return if your TRN is linked to customs. But in case of import of service, so many people are not reporting the import of services in the VAT return box number 3. So whenever you import goods or services, you are required to report in the VAT return. If you are importing services, you are required to report in box number 3, and if you are importing goods, then that import value will be automatically populated in the box number 6. And if the imported goods or services are used to make taxable supplies, then you are allowed to claim those import VAT under RCM in box number 10. If you are using for personal use or for any other purposes other than business, then you are not allowed to claim RCM in the VAT return. And importers, in the case of importer services, so recently FTA issued one public clarification mentioning that whenever there is an import of service from a a non-resident supplier, you have to do self invoicing. That means if you are failed to receive the invoices from your foreign supplier, overseas supplier, then the importer has to account for output VAT and input VAT and issue a tax invoice to himself, mentioning the description, the date of supply and everything. So the value and supply details. So in most of the cases, VAT residents are not getting a proper invoice from the overseas suppliers. So here in these situations, to comply with the VAT law and record keeping requirements, you have to issue tax invoice to yourself, and you need to keep this to claim the input VAT. So common RCM errors could be like failing to identify what are the import of services that are subjected to RCM, then incorrect accounting. So not accounting properly for output VAT and input VAT in the same VAT return. Then inadequate documentation, as I said, lack of getting proper invoices from the overseas suppliers. Then incorrect tax period. So if you are misreporting, for example, if you receive a service from the outside suppliers in the tax period, but you are reporting, there could be chances that you will be reporting in the later VAT returns. So that is not correct. You have to report the importer service in the quarter which you have received the service. Then import and export of goods via documentation. So as Balam sir previously mentioned, in order to apply zero rate of VAT for your export transaction, you need to keep proper documentation to prove it is actually exported from the UAE. The goods are exported from the UAE. To prove that, there are some documents that you need to keep it in your records. So I will be explaining those details. Here, tax invoice, commercial invoice or tax invoice, you must keep your tax invoice when you export goods from the UAE to outside UAE. Then FTA is giving options, combination of documents that you need to keep in the record. So if you you have to keep export declaration from the UAE custom. That means the custom document plus commercial evidence which proves the goods are being shipped from UAE to outside UAE, like airway bill if the transportation happens by air, bill of lading if it is by sea, then transport bill if it is by road. So if you maintain commercial invoice, custom document plus airway bill, bill of lading or transport bill, then you can treat those transactions as zero rated. If any of the documents is missed, then you are not allowed to report, you are not allowed to apply zero rate of VAT. Instead, you will have to treat them as local supply. And another combination is if you fail to get the airway bill or bill of lading or transport bill, then you can arrange to get the shipping certificate, which is equivalent to commercial evidence and official evidence, that export certificate or clearance certificate from the customs authority. If you do not get any clearance certificate from the customs, UAE customs, then it is okay if you can arrange the clearance certificate from the destination country. And if you export the goods and goods are put into customs, then you have to give the declarations and as a proof that goods have been put into customs within 90 days from the date of supply. Here there is a requirement from the FTA that the tax records you need to keep up to 5 years from the date of supply. So here, if you fail, whenever you make a transactions sales, whether it is output or input, you need to keep the efficient supporting documents, invoices, contracts, whatever it is, and especially for export transactions for a period of up to 5 years. Otherwise, if you fail to do so, there will be a penalty ranging from 10,000 dirhams to 20,000 dirhams. So many people, so during many FTA audits, many businesses are facing a challenge in retrieving the documents past records. So it is mandatory to keep the records of the documents. So here common documentation mistakes are not keeping proper records, missing or incomplete tax invoices, credit notes, lack of documentation for input claims. The retention period is 5 years, and if there are real estate transactions for real estate businesses, the retention period is 15 years. Another area of most common mistakes happens during when we issue the invoices is applying the wrong exchange rate. As I said earlier, whenever you issue tax invoices, you need to follow the exchange rate published by the UAE Central Bank. So first you need to identify what is the date of supply. So date of supply could be different. There are different dates. So most common dates are date of issue of tax invoice, date of receipt of payment, date of delivery of goods or provision of service. Whichever comes earlier, that will be the date of supply. So on that date of supply, what is the exchange rate published by the UAE Central Bank? That rate you have to mention on your invoice, and you have to use that rate to convert that foreign currency amount to AED. Incorrect VAT treatment for advance payments. So there could be situations like businesses are getting advance in before issuing tax invoice or before delivery of the goods. So these advances will trigger the date of supply. So first, as I said before, the date of supply could happen earlier of the date of invoice, date of payments, then date of delivery of goods or provision of service. So whichever comes earlier, that will be the date of supply. So when you receive advance, then that receipt of that amount, that will be the date of supply. So you have to report that particular transactions in the VAT return when you receive that advance. You have to collect the VAT if that is a local supply. So most common mistake that people are not aware that whenever there is, some people might be thinking that whenever they receive, sorry, whenever they issue tax invoice, then only they have to report the tax. It is not that. So you have to follow the date of date of supply rules as per the UAE VAT law. So common mistakes includes failing to account for VAT at the time of receiving the advance, treating advance payment as non-taxable until the final invoice is issued, not issuing a proper tax invoice of or receipt or receipt voucher for the advance, confusion around partial versus full payments and how VAT applies. So whenever you receive advance, there is another requirement. You must issue full tax in, you must issue tax invoice within 14 days of the date of supply. If you fail to do so, there will be penalties FTA will be imposing. Then, as per the recent amendment from the FTA, so if you are issuing simplified tax invoice, then you have to issue tax invoices on the date of supply. You cannot wait until 14 days. If you are issuing full tax invoice, then you can enjoy that 14 days period to issue the tax invoice from the date of payment, advance payment. So there are some corrective actions that you can take care from your side to ensure the compliance and to ensure that the advance payments are promptly recorded in the VAT returns. So you need to track the advance payments properly, and you need to ascertain that what is the nature of transactions, what is the VAT rate, and you have to apply correctly the VAT rate. Then you need to make sure that in which quarter that particular advance have been received. So suppose if there is a quarter like January, February, March, you received advance in this quarter, but you have supplied the goods or you have issued the invoices in the next quarter. So here date of supply comes in the quarter of January, February, March. So you need to report that particular VAT amount and that advance amount in the return of in the quarter January, February, March. And another area of claiming the input VAT, another area of mistake is claiming input VAT on the exempted supplies. So if you are making the taxable supplies, then only you are eligible to claim input. If your supplies are in exempted in nature, like local passenger transportation, financial services, supply of bare land and residential property after first supply of residential property after 3 years of completion or subsequent supply of residential property. So when you make these kind of exempted supplies, you are not allowed to claim the input VAT. And of course, there are timelines to claim the input VAT. So it is the FTA has been given some time period in which you can claim the input VAT. So if you, there are some conditions. The primary conditions to claim input VAT is you must have received the proper tax invoices. You must have to pay the consideration, or there is an intention to make the payment within 6 months period. Then you need to keep the invoices in your records. If you meet these conditions, then only you are allowed to claim the input VAT. So if these conditions happen in which period, then only you will be able to claim the input particular in that particular quarter. And if you miss to claim an input VAT in a particular quarter, then you will be eligible to claim that input in the subsequent quarter. After that subsequent quarter, that input claim will be lapsed. You will not be eligible to claim the input VAT. So these are the conditions. Input VAT can be claimed in the tax period in which the tax invoices is received and supplier payment is made, or if there is an intention to make the supplier payments within the 6 months period. Then alternative claim period. So if you miss to, as I said, if you miss to claim the input VAT in a quarter where these two conditions are satisfied, then you are eligible to claim the input in the immediately subsequent quarter. And suppose there could be chances that you might have received the tax invoices and there was an intention to make supplier payments within 6 months from the date of payment, but subsequently due to some reasons, if you are failed to make the supplier payments from the 6 months from the agreed date of payment and you had claimed the input VAT, then after that period of that 6 months, you have to reverse the input which you have claimed already. And in future, when you make that supplier payments, then you can reclaim that input in the quarter which you have paid that supplier payment. So the another important area is to update the tax records in the Imara tax portal. So whenever there is a change which alters your tax records which is kept by the FTA during the registration process, you have to update your tax records within 20 working days of the change. Here the what are the information that you need to update on the portal. So that I'll be explaining below. Here the types of amendment. This is called amended taxable person details. Okay, this process is called amended taxable person details. So always your tax records needs to be up to date. So many people are failing here in this when updating the tax records. So if you are a registered person and any circumstances occur that will impact your tax records kept by the FTA, you must inform the FTA by updating your tax records. Means whenever there is a change happens on the license of the company and the KYC details like HMRC and passport details of the shareholders and managers, then the taxable person is required to update the FTA portal by submitting the taxable person's details, application. So these are the common changes that may happen on the license. Company name change, activity change, then expiry date, shareholders pattern, shareholding pattern. If the shareholding pattern is changed, then other signatory change, legal status change requires deregistration, registration as I mentioned before. Then office address change, then KYC, if there is any change in the KYC details of the shareholders or managers, then also VAT amendments to be done. Then any other changes on the license or KYC details. So especially whenever there is a renewal of the license or KYC documents of the passport, like passport or Emirates ID, you have to update the tax records within 20 working days. If you fail to do so, there will be a penalty of 5,000 dirhams for the first time. If you repeat, then the penalty will go to the 10,000, up to 10,000. So after this webinar, we advise you to log into your Imara Tax portal and see if there is any amendments or any information coming in the required actions tab. So next, here you can ask the questions and we will try to attend. And if we miss to address your queries, then definitely we will get back to you by email or by call. So I'll be reading some of the questions. So there, there are lots of questions. So here, vehicle is used from site to camp accommodation of employees. In that case, whether we can claim input credit or not. So as I said, if as Balansa said, if the vehicle, if the company is monitoring the usage of the vehicle and if there is a documented policy in place to monitor the usage of vehicle and there is a requirement, sorry, there is a documentary evidence and if it is a general practice to provide these services to such category of employees, then you are allowed to claim input. Okay. Then next one is the 12 months to determine the threshold start at any time or from the end of the fiscal year. So whenever you have to register for VAT or deregister. So there is a time limit to calculate the threshold. So if your taxable turnover or expenses, if it is more than or less than that threshold of previous 12 months, this previous 12 months you need to calculate every time. So here not a, it is not based on the calendar year. So every month you have to check your previous 12 months turnover. What is your previous 12 months turnover? Then based on that, you have to take actions, whether to register for VAT or deregister from VAT. So suppose if now we are in July, so you have to calculate the previous 12 months backwards from July. Then what is the difference between commercial invoice and tax invoice? Yeah. So commercial invoice, so if you are making the out of scope supplies, for example, if there is a third port shipment, then you are not allowed to raise tax invoice. Instead, you have to issue commercial invoice is not a tax invoice. Okay. What about VAT levy on third port shipments? So there are transactions that are actually happening outside the UAE. Third port, we can say that a third port shipment. If the UAE company purchases goods from an overseas supplier and directly shipping to a customer which is also located outside the UAE without that goods coming to UAE. This is called third port shipment. Here the VAT, the nature of the transactions will be treated as out of scope. So it is not a taxable supply and you do not have to report in the VAT return. Business submit zero amount in VAT. Shall I need to deregister? We expecting business. So if you are filing the nil returns and if your taxable supplies of previous 12 months are less than the threshold limit of 187,500, you must have to deregister from the VAT. In some cases, advance payment supplier will issue pro forma invoice. On that basis, we cannot claim VAT. Yes, so there are cases that supplier first issue a pro forma invoice with VAT. It will be showing the VAT also sometimes. So please note that the pro forma invoice is not a tax invoice. It has no legality. So whenever you receive a tax invoice, then only you are allowed to claim the input VAT. Advances are taxable for goods as well as services. Yes, advances are taxable. It depends on the nature of transactions. If it is a taxable supply of goods or services, then if you have received advance against that supply, then it is you are required to report in the VAT return based on the date of supply. What if amendments are made after 20 days, so moto, that is not after FTA notice? Then also penalty will be yes. If you have, if you fail to uh, update your tax records within 20 working days of the any changes happening on your tax records, then FTA will impose the penalties. In case of advance payment received, is it necessary to pay VAT on the full invoice or on the advance payment received? You have to pay VAT on the advance payment received and you have to report in the VAT return, not on the full amount. If the company is unable to make the payment within 6 months, we can reverse the invoice and claim the VAT after making the payment. In that case, do we need to issue and do we need to receive? Sorry, do we need to issue a new invoice or is the backdated invoice is fine? Yes, backdated invoice is fine. There is no need to raise new invoice with the current date. But if FTA asks, you have to demonstrate that you had claimed input earlier and because of so and so reason we couldn't make the payment. So hence we reverse the input and after making the payment, we are claiming back that amount. Sole establishment cross 375K, is it important? Yes. If the business is a sole establishment and if your taxable supplies are crossing 375,000, it is mandatory to register for VAT. Can I book an expense based on the pro forma invoice? You can book expense, but you cannot claim input VAT when you receive the pro forma invoice. How and by when can I change the office address in the FTA portal? So there is an option to submit the VAT amendment. So there are two types of amendment generally. This one is amend taxable person, one is the VAT registration amendment. So when you apply for the VAT registration amendment, then you can change the address. And that address needs to be changed within 20 working days of the change. So you will be getting the new Ijari. So you have to update the tax records within 20 working days of the new Ijari date. If the company is fully engaged in the out of scope supplies, can they claim input VAT? So in Article 52, if if I am not wrong, you can claim input VAT if you make taxable supplies or if you make a supplies that are happening outside the UAE. But if those supplies would have been a taxable supply if it is made in the UAE. That means, for example, supply between designated zone. Generally, it will be out of scope, but you are allowed to claim input VAT because if that particular supply happened in the mainland, then we need to check whether it would have been a taxable supply. If yes, then you can claim input VAT on that. We have one client forgot to notify FTA input VAT of AD to 50,000 and zero rated supply sales in the year 2023. So in this case, you have to submit the voluntary disclosure in that particular quarter. Then you can claim that amount. And here there is a zero rated sales which is missed to report. If you have understated or overstated that zero rated supplies, exempted supplies, if there is any misreporting of Emirates, then it is mandatory to submit the VD even if there is no tax impact. So here, because of time limitations, we are concluding and there are many queries that we need yet to address. So we'll be attending those queries by email or via calls. And thank you for attending this webinar and we hope that you got some points and yeah, at any time you can reach out to us if you have any questions or concerns or need clarifications. Definitely we will be addressing those. And thank you all and have a good day.